Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, February 22nd, 2016. In this video, I'll take a quick look at gold and GDX, and what I wanted to talk on really is the relationship or the correlation between the two. You know, it was brought up in the trading room this morning. Somebody mentioned the relative strength in gold or GDX, how impressive it was lately, and you know that could be looked at either through the glass being half full or the glass half empty. If you're bullish on the miners, you can take it any way you want. Relative strength, for those of you not familiar with the term, it just talks about one asset or security relative to another, or it can be used in the sense, for example, let's say we're in a bear market and the stock market's has dropped 20%, and you look at a stock like, let's say, Procter and Gamble, and it's up or flat during that time period. You would say that Procter and Gamble has relative strength to the broad market, meaning maybe it didn't go up, but it didn't drop 20% when the average stock did. So that's relative strength, and I look at the miners. Now, for those of you who followed the site for a while, you've probably heard me say dozens, if not hundreds of times, that trading the miners or the gold mining stocks are essentially a leveraged play on gold. And I've talked about that. That just has to do with the fundamentals. When the price of gold goes up X, the miners will go up 2, 3, sometimes 5 times X. And I did take a look at the chart the other night, a long-term chart of both gold and GDX. And I measured some of the percentage moves from the peak to trough, or I should say trough to peak during some rallies. And I came up, and this was just an eyeball thing I did on the chart using a measuring tool. Off the lows in 2009 after that waterfall sell-off, the miners went up. It was about a 5-time, the initial strong rally was about 5 times greater than that of gold in percentage terms. And, over time, it usually ranges about, I was coming up with an average about 30% or 300%, about 3 times that of gold. So in other words, if gold makes 10% gain, miners will go up 30%. And again, that varies widely. There's ratios that you can look at, gold, GDX ratios, and things like that. What we're going to do today is just look at the near-term outlook here, because we're all trying to figure out, how long this rally in gold and the mining stocks can go. Some of us are looking to position long on a pullback. Some of us, put up for the first time in a while, what I call an official short trade idea on the miners today. And I'll talk about that here. So what we're looking at, this is a chart, just a 30-minute time frame that goes back to the beginning of the year. Most of you are probably aware that this rally in the mining stocks and really gold started a little earlier. Gold bottomed back in December, around December 17th were the lows. And the miners didn't play catch up for a while. And what I'm looking at here is U-Gold. Now, the reason is you can put in gold, but as I just talked about, the miners are a leverage play on gold, and recently the miners ripped up. I did the math. You can look at it yourself. These are rough numbers using a measuring tool. But from the January 19th lows in GDX to the February 12th highs, GDX rose about 52%. Now, gold, as I mentioned, bottomed earlier, almost about a month earlier. And from the 1217 low up to the 1211 high, or 211 high, so a day before GDX topped, gold rose 20%. So there's better than 2.5 times rise in the miners. GDX up 52% off their lows, and gold up 20%. And also that took an extra month for gold to do that 20%. U-Gold is the 3-time leveraged long gold, and that's up about 71% off its lows. And we'll look at that. There's UGLD. And you can just measure here. This is the black line. Take a measuring tool, and you can see that. If you look in the back here. We got to go back to December. My bad. And you just look at the box on the left, and you'll see there for some reason. Oh, I'm not using candlesticks. I did that on a candlestick chart, so I clipped the low on a candlestick, and that's the number I got. So we can do it this way just as well. So if you're looking at a line chart which excludes the intraday whips and dips, or rips and dips I should say, the highs and lows, it only has closing values when you're using a line chart. That's about a 63% gain versus over that time period there's GDX, and you can see there's that 52% gain I was talking about. So I'm using U-Gold. I could use DGP, which I just mentioned went up, was it 42%? The only problem is DGP, see the black line here, made a higher high recently. That's not what happened in gold. For some reason, there's some funky things going on. There's gold right there. Gold has failed. Gold made a lower high recently. And DGP, it might be dividends, capital gains, something it paid out. But there's a disconnect there, so we're going to use U-Gold. All right, so there's U-Gold, which again, I'm just leveraging up gold 3 times, which comes much closer to matching the move in GDX because of that leveraged relationship. And now what we're going to talk about here are mean reversions. Mean reversion number 1. Back in January, you'll recall, and you can reference all these notes on the site, I had continually pointed out that the miners had plunged. They took out a key level, I think it was at $18 on the GDX chart. They took out key support, and I was pointing out at the time that gold was holding up relatively well. And gold is the important thing. I always say this too. If you get the call right on gold, you will get the call right on the miners. There are temporary disconnects, and if gold is rising or holding up when the miners fall, sure, gold could turn around and play catch up to the downside, but more importantly, remember the miners track the metals. It's not the other way around. Wherever gold goes, the miners will follow, and these temporary disconnects can be a trader's best friend if you can recognize them. So back then I had mentioned that gold was holding up well. It's not going to show well in this chart, and the miners actually broke that support, and I had predicted that we might see a fake out, flush out move, and that's exactly what happened. It was very powerful when the miners regained that broken support, and again, that was on a candlestick chart. It's not going to show well here on this line chart. We saw that powerful rip. So there it is. You can kind of see that gold had held up. Gold was well above its lows that it bottomed in December, back when the miners were making new lows, and that was that disconnect I talked about. That's a mean reversion. So what happened? Gold held up, continued to rise. Miners had a vicious, violent game of catch up to play, and that's exactly what they did. So that's a mean reversion right there, and that's what I talked about on this site. I made a comment to the relative strength in the miners lately that mean reversions can be a bitch. It's whether if you're on the wrong side of them, that is. So let's just look at the history since then. We can go back. What I have these lines on the left of the chart as I scroll, it's starting both at the same point. And you can point out here, or you can note that the blue line being GDX, you can see that when it gets ahead of itself, they usually track together. Here's a strong run. GDX got ahead of itself and had a nice sharp correction. Another disconnect, GDX getting ahead of itself versus gold here, and then look what happened. GDX came back in, and it came back in harder than gold. Let's see, another disconnect here. We had gold actually from this point get ahead, and then GDX made a sharp rally there. So, but for the most part, you can see they track very closely. And now what I'm fast forwarding to, and we'll talk about today. So let's just look at the most recent peak in gold right here at this top. So I'm going to take this, we're going to slide over to that point, since this chart will start all points on the left of the chart at the same level. So now this is what I'm trying to highlight here. The black line is gold, and so this goes back to the highs on February 11th that gold made right here to the left of the chart. And again, we're using UGLD for reasons I explained in the beginning. And you can see, as I said, UGLD has mirrored gold very closely, almost perfectly, especially as recently. And that's why I'm using this here instead of the DGP. And you can see that that move down in gold, and look at the miners. They're exactly where they were when gold peaked. So now one of two things happens from this point. There will almost certainly be a reversion to the mean, and that can manifest itself in one of 3 ways, really. It can be gold stocks down, and when they move, they can move sharply. It could also be gold up. Maybe those in the know that are continuing to buy gold stocks at these levels believe that gold will turn around and play catch up to the upside and catch up to the miners, or both could come together. And the latter two would be at least the latter two, the gold GDX down and or GDX down and gold up. In other words, they both trade sideways for a while, catch up. You see GDX soften a little bit over the next few days. In other words, trading weaker than gold. Gold may be moving back up a little, but not a whole lot, not taking out the new highs. a sideways trading range. As I mentioned, that would be beneficial for the nugget short. Of course, any move down in GDX would be beneficial for a nugget short. And the only thing that wouldn't be is if gold starts to move up and the miners don't even, the miners already priced in the fact that gold was only taking a little breather here and is going to head back up, and the miners could continue up. So any of that can happen, and if they do, then the nugget trade will get stopped out, and we'll move on to the next one. So that's what I wanted to talk about, are these reversions, mean reversions, and right now we have a pretty pronounced difference between the two. Zooming out here, you can sort of see the gap right there. We had a gap right here, as you can see, where gold got ahead of the miners. And you can see the miners actually then shot up as gold was coming down. See that mean reversion right there? That's what I'm talking about. Gold up, miners didn't do anything. Gold started correcting, but the miners had some catch up. And that's where they both came together. That's that other scenario I was talking about, which we could see here again. We could see the inverse of this. We could see gold move up and the miners come down. But again, that would be beneficial to a nugget short, especially if they just chopped around for a few weeks to do so. So this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.